Welcome back to another episode of What's on Your Mind. I'm delighted today to have Edward Shek and Raj Malhotra joining me on the show. Gents, it's great to have you back once again. And I myself am looking forward to hearing what you guys have to say, much like everyone watching, both on sort of markets and also what you might be thinking about in terms of equity ideas for your portfolios. So with that being said, let's just jump straight into it. And Ed, you can get the ball rolling.
Hello. Hi, Chris. Hello, Big Raj. So what's on my mind? So market having a decent rally, 10% off its lows. The Dow up 14% in October. Best month since 1976. All this sort of useless data. Bit of dovishness finding itself into the equation. We'll talk a bit about rents later. Earnings, not a disaster. Guidance average, not a disaster. Market's taken mega tech, mega disaster extremely well. Positioning bearish, technically positive. Pain trade is up. Fed tomorrow. So the first thing I'll mention is there are some remarkable similarities between this setup and the Q2 setup. So if you remember, super bearish, market near the lows, Q2 earnings not a disaster, bit of dovish found its way, and the market rallied 17% into Jackson Hole. Now, I'm not saying anything similar is going to happen, but my net problem is that I'm still very bearish on corporate profitability heading into 2023. But I see the tactical rally continuing. And who's to say we could easily have a year-end rally from here? But for me, the rate situation hasn't really changed. And I always marvel at the narrative going into a Fed meeting about this excitement about a slowing rate rise increments coming in. But the dot plot's been the dot plot for ages. So we're going to get 75, then it will go to 50, and then depending on which analyst you're reading, rates are going to go up in 25 basis increments once, twice, or three times in Q1. So I think we've known that. Of course, the rate of rate increase is going to slow down. So for me, again, this tells me nothing new. Now, the genuine good news on the dovishness, and there's been a lot of huffing and puffing in the bond market, and really since I've last been on, the 2-year down a few basis points and the 10 years down maybe 20, 25. And we've seen some genuinely promising news coming out of the rental markets. So rents are starting to slow. Demand is backing away, so people are just not going to pay rent the current rates in some markets. And that is a good thing. Obviously, homeowner equivalent is obviously the largest part of CPI. So any relief in rents should start to feed through. So that is good news, no doubt. But it's still a long way to go before we talk about this pivot and, all this ridiculous pivot chat. So my base case is terminal rates, yeah, they might be 4.5, 4.75. Some, as Goldman said, 5, fine. But my bearishness for corporate profitability, and this is well documented in the ITPM Society Discord channel, is that as long as rates stay up there for some time, it's not bullish for equities, in my opinion. It's not bullish for corporate profitability. And the longer they stay up and sustained at a sensible rate, that will continue, in my opinion, to cause a drag. Now, one thing that's worrying me looking forward is the savings rate. So we're continually told about the strong jobs market and how robust the consumer is. But savings rates are now that below pre-COVID levels. So there's been an awful lot of the excess has been spent. And whether you want to term it as revenge travel and all this sort of thing, consumers have been spending. But I think it's at an unsustainable rate. So whilst Q3 or the earnings that we're in the middle of now haven't been disastrous, the outlooks are not particularly positive. So if anything, I think that the sort of harder landing aspects have just been delayed by another quarter. Okay. So when we come to the idea that I'm going to talk today, the reality is it's not actionable today. So it's difficult for me to get longer than I am, because I can't find anything that I would trade today. There are lots of potential longs, and I'm sure Raj is going to mention this point, and I've got lots of potential shorts, but in a market where the pain trades up, these are also suboptimal. And sometimes it's like this. So I have to lose a sense of the fear of missing out. What I'm certainly not going to do is just get longer the market because I think in the next week or month it's going up if the fundamentals and the return don't support it. So there's a very big difference between, wow, earnings could have been horrific, they're not, and the market's short, and we get a squeeze for a couple of weeks. That's very different from real long-only money buying these stocks for the medium term because margins are improving, earnings are improving. So I think this bounce, in my mind, is more tactical in nature, and we're not trading the market. We're trying to trade 12 positions that have got excellent risk-reward characteristics. So that's my little chat. And Raj, any agreement, disagreement?
I agree with a lot of what you've said, Ed, in terms of, first of all, like in the big picture, I have been tactically bullish this month, and for a bunch of reasons. Now it's easy to say now, but, we've been way overdue for this bounce. And, even though macro data has been weak, as you said, and by the way, earnings themselves, at least like if you look at the big cap, tech, that's been super, none except for Apple, Google, Facebook, which was one of my biggest shorts, Amazon, they all disappointed. But one thing on the contrary, what you've seen is you have seen extreme sentiment, which is bearish, which is really, I think that's really what's been driving this market. There's also a seasonality effect in where if you look at October, typically that's where bear markets have tended to bottom. If you look at the market crash in 1987, 2008, they all happened in October. And maybe I think that's what a lot of market participants were looking for, a huge flush out where everyone was looking for that as a buying opportunity. And when everyone's looking for the same thing, it rarely happens. One thing you talked about was the Fed cycle. And my view on that is, as when markets have seen less of an increase, that tended to be a little bit bullish for the market. I think people were looking past that. There's a lot of people that believe December will be the last one for a while, and then we pause. So if that happens, that could be again, that's not going to fix corporate profitability, but that is the uncertainty taken out of the markets in many people's minds. Because remember this, the markets can deal with bad news. The markets hate uncertainty more than anything else. So a certain outcome that may not be good, at least people can move on from that. And that's that might be another reason why we've seen this rally, as a lot of the bears have, they've been there for a while, have actually backed off on that call this month.
Yeah.
So one thing I want to show you is a chart that I was looking at here. This comes from B of A in terms of their global their sentiment indicators and some of the contrarian indicators. So the one that really sticks out to me is the first one here. You see the bull bear indicator. When the sentiment is above 8, it's bearish. When it's below 2, it's 0. It was below 2, it's bearish. It was at 0. You look at this chart here. If you look at it here, it's at an extreme bearish level versus if you look back at February 2021, which was the high year, it was almost at 8, which was flashing a sell signal. So in terms of that, and in terms of also hedge fund positioning, it's been a bloodbath for the long short hedge funds, the ones that are basically have strategies similar to us, where they want longs and shorts and are supposed to be somewhat market neutral. It's been a bloodbath for these guys, and I really believe that there is a likelihood that the market continues to rally into year end, because that will get these long shorts out of business. I really think there's going to be a flush out, not in the equity market, but in the hedge fund community, because the same funds that lagged the S&P last year, and if they're down again this year on an absolute basis, I don't know what their pitch is to investors going forward. Their Melvin Capital was a very notable one that's already closed shop, but there'll be others, because you underperform in a bull market or even down, and you underperform in a bear market. I'm not exactly sure what market you're pitching yourself to investors as give me money, because I will do worse than the market in both directions. Not exactly a easy way to raise capital. So there are, but to your point too, there are. I believe the macro picture isn't great. Earnings probably won't be great in Q1. Businesses will probably cut down their spend, and with all this uncertainty. And again, businesses hate uncertainty, just like the markets do. If they knew an outcome was certain, they can plan better. But with so much uncertainty, it's very hard to plan for your technology spend, employees, bonuses, all that. It makes it very hard to plan. So therefore, that's why very few companies have actually guided, showing guidance that's bullish. And even if they are bullish, there's no reason for them to come out and say that we are very positive on what's going to happen, because it only sets themselves up for failure if that doesn't happen indeed.
So that kind of what you guys have said there obviously sets like a nice kind of background picture to what you're thinking. And I know that the ideas that you're looking at the moment might not necessarily be right now in terms of timing and putting them on. But what are you looking at, Ed?
So the company I'm going to talk about today is called Impinj. The ticker's PI. It was about a $2.3 billion company that's now a $3 billion company post results. And the reason why I want to talk about it is it's one that you should have on your list. Okay, it's a good stock to be aware of simply because of the enormous addressable market opportunity. So it's in IT and semiconductors, and it basically operates a cloud connectivity platform. It's about the Internet of Things solutions. But basically, we're just talking about digital life for potentially trillions of everyday items. So it's wirelessly connecting individual items and delivers data to business and consumer apps. So before we get into the technology, RAIN technology, it's basically replacing barcodes, okay? So it's got a radio frequency. It uses the free spectrum, spectrum that's free in 90% of the world. So if you think about it simply, you go into a shop and you're looking at a clothing item. It's got a barcode. So all the data's in the barcode, but you've got to scan it. With RAIN, you've got a little transmitter, and that's just sending out all the information to the main hub. So the implications are absolutely massive. So RAIN just means radio identification. It's extremely cheap, obviously autonomous, so it operates without line of sight, battery free, and it uses the worldwide spectrum. So it has 4 components to having an Impinj system. One is a reader and gateway. So this is like a little bit of kit, size of like your Skype, your broadband, it's just basically something that small that acts as the hub. Then you've got the reader software, then you've got the reader chips, and then you've got what they call the endpoint ICs. So these are the little chips that are actually on the product. That's it. And it's not very expensive. So readers and gateways are in the sort of tens of thousands, and the endpoint ICs are in the pennies. So whatever your operation, this is not a huge investment for suddenly making absolutely enormous efficiencies. So when we think about the current market, they reckon about 30 billion items use this RAIN technology. And they think that's about 0.3% of the number of things. So just to give you some context, there are 3 trillion food and drink packages used annually, 600 billion auto parts, 400 billion parcels, 80 billion pieces of apparel, 7 billion pallets in warehouses, 4 billion luggage items, so on and so forth. Now, I'm not going to run through all of the different sector breakdowns, but if you think back to the clothes shop, even if you're doing a stock check, that requires physical counting or physical scanning. Now, you don't need to do anything. All right, these things have decent enough range. You can either walk around with a wand or it just all feeds straight back in. So basically, all this information is happening every minute of every day with no one having to do anything. So it improves massively inventory visibility, huge efficiencies, better visibility through the entire fulfillment process. When it comes to, it's very good for self-checkout and loss prevention as well. That's another improvement over the barcode. Just taking warehouses as an example, using Impinj reduces the time taken of loading up and organizing warehouses, loading up trucks by 25%. So this is a really great product. Adoption's relatively easy and the market is massive. Now, the other competitive advantage, and this is comparing to NXP or Zebra, is Impinj is the integrated platform. It does the whole thing. So it's the only company that can do the whole start to finish installation. Now, when I looked at this a couple of weeks ago, they're expecting their full year earnings to be 52 cents. They reported it's gone up to 90. Okay. Revenue next year has gone up to 26% year on year, and earnings have gone up to $1.18. That was from 78. So they've just reported they've shot the lights out. Stock's gone up 30%. Obviously, not exactly the right time to buy it. However, it's only a $3 billion company. When you read the last earnings report, there are two things that I'll talk about. One is their supply side constrained massively. So they can't satisfy anywhere near their demand. They can't get enough of the chips. So they're doing everything they can from procurement. If the economy slows down, it is possible that other businesses may have some spare capacity and they could pick up some of the slack because their demand is just shooting the lights out. Now, that's obviously a constraint, but it's obviously a future huge catalyst because when they can, they're just going to be selling more and more. Okay. The second point is their margins have gone up. So they have got cost pressures. There's a shortage. Everything's costing more from the technology side. But their product's so good, market leader, and at a low entry point, increasing prices is not a problem. They've had no blowback. Their order book's growing and growing. People want what they're selling. They've got margin expansion plus a catalyst of easing supply chains. So obviously, just up 30%, it's not a great time. Would I buy this on weakness? Yeah, you can buy the stock now, but I tend not to do that. I tend never to do that because I'm always looking for higher returns than stock can give me. So I'm a buyer of options for next earnings on any form of weakness. But I also aware that this stock could grow multiple times in the next few years. Okay, they're best in class, operational leverage, huge backlog. And if supply chains ease, their numbers will just get upgraded. So either way, it's a really interesting stock. It's great to have these stocks whose business models you think are awesome, who really could grow 10 times in the next 10 years. It's that sort of stock. So keep it on your watch lists. Look for good entry points. Impinj, PI. That's it.
Awesome. Good stuff. Sounds like a great one. And Raj, let's go to you. Have you got anything on the equity side?
Yeah, like Ed, it's been hard to find longs here. Like a lot of the longs that I've liked are, up 20, 30%, which is no surprise with, especially with beta adjusted with the market up double digits. Some of these names have been beaten down. Have certainly been up a lot more than that. I have one long I'm going to present. I wanted to present some shorts. Unfortunately, a lot of them have either already reported, like Facebook and Snap, or are reporting this week, like Coinbase or Wayfair, which I covered last time, or Paramount. So as we go to, as this gets shown out to the world, the stocks will be markedly different and hopefully much lower than where they are today. So I'll pass on my shorts there, but I will take a opportunity to discuss one long, and I will preface this kind of like Ed, and I think this is a longer term long, and I might be early on this one because I think more of it is going to come next year, and it'll take a while. Like Ed said, also it takes a while for the market to look past some of the to look at the total. This company has a very large total addressable market, like Impinj, like Ed was talking about, and like I said, it might be a little early. But having said that, let's give it a go. The stock is Palantir. The ticker is PLTR. It's a big U.S. software company that specializes in data analytics. The company builds software that enables organizations to effectively integrate their data, their decisions, and operations. So let's look at some of the quants on the stock. The stock's trading around 8.5 as we chat. The stock, it's up about 20% from its absolute low. But having said that, it's down a ton for this year. So there is some room for it to grow here. The market cap's around 17.5 billion. It's around a break even. So there's no PE and they don't pay a dividend. And like I said, it's down. I think it's down 50+% year to date. So let's look back at they're reporting on November 7th. So let's look back at Q2 earnings. They reported a loss of 2 cents versus expectations of positive 3 cents, which was really what the market didn't like. But if you look below the surface, I think there were some really positive outcomes. Their revenue slightly beat expectations at 470 million versus 468 million in expectations. But on the bright side of that, the revenue grew 26% year over year. The U.S. revenue just in the U.S. grew over 45% year over year. And most importantly to me, their commercial revenue grew 46% year over year, and in the U.S. it grew 120%. Now, why that's important was this company was often seen as just a government contractor, where the government was basically all of their revenues. And stock analysts in the street don't like where there's such concentration risk with one customer, even if it's the U.S. government, which, as we know, has more money than if they run out of money, they just print more. So they'll have plenty of money to spend at all times. But even that, their government revenue still grew 27% year over year. And if you look at the number of customers, the U.S. commercial customers they had 34 in Q2 2021 and 119 in Q2 2022. They signed a lot more customers, and I'll go into a little bit more later and why that's important, and why that doesn't actually flow down to revenue just yet, and why I think that's an underappreciated part of this stock. And if you look at they're operating. They had a loss of $42 million from operations, but their margin was up 3,000 basis points year over year. So they are moving towards profitability, and I think that's very important, and that's something the market's will care about in a different market environment. The market would care about it more. If we were in 2021, they might have cared about it more. In the market we're in, investors just looking past that. But like I said, even if you looked at the broader market, not to change subjects here, there's been positives underneath the call them green shoots, but if you look under the hood, there have been some positive data points. If you look at some technicals in the broader market, but not to go back to Palantir again, if you look under the hood, there have been some positives in those numbers. So in terms of earnings coming up on November 7th, they're expecting around $475 million of revenue, and they're looking for a full year revenue around $1.9 billion. Interestingly enough, the street is expecting a 2 cent profit, but the whisper number is actually at break even, which is rare to see the whisper number below the market. So I believe any inline or slightly better results could actually move the stock higher. And any guidance increases could make the stock go up a lot here. So, and I'm also expecting more clarity on their newer customers. And the most important thing is how much time it takes to monetize them. So, in terms of the stock's valuation right now, the stock trades at 9 times sales, which is very low for a high growth company, and a stock that's a market leader and one with obviously a huge TAM or total addressable market. If you look forward, it's trading at 5 times sales estimate for 2024, which is really cheap historically for a company of this growth. Obviously, rates much higher, people discount that. And like I said, so if they were in a different market, if this stock was trading in the mid-20s not too long ago. And if you look at their cash on hand, they've got $2.5 billion. So that 15% of their, which is 15% of their market cap. So it's not like this company, like some other growth companies, are going to run out of money anytime soon. And that serves them well if they have to, wait through an economic downturn. They should be okay. So importantly on their business, go into a little bit about it. They serve customers in many industries, from autos to healthcare or government. And basically they help their companies manage their data with operational efficiency. So their software basically helps predict future events by analyzing the past. That sounds like AI. That's a lot of it is AI. But it has wide-reaching uses such as identifying money laundering operations, detecting fraud, even mitigating wildfires. So, and what they've done recently, they've announced some really big partnerships with companies in a wide array of industries. I'll highlight three here since they're all very divergent. One, they partner with Concordance Healthcare, which set up a medical supply chain ecosystem. Obviously, as you know, supply chain issues have been challenging in every industry. And if Palantir can prove to the street or other companies that they can improve supply chain issues, especially in such a disjointed sector like healthcare, that'll have far-reaching positive implications for the company and certainly across the whole economy. They partnered with Department of Homeland Security to support their, they call it HSI, but it's a Homeland Security Investigations, as well as their ICM, which is Investigative Case Management Operations. That contract was for $96 million over 5 years. And what that does is, which is very fascinating work, they've basically helped the government stopping or slowing down human trafficking, drug trafficking, identifying fraud, also like trying to help predict where violence may occur. I don't know how that's going to work, but that's what they say. Again, it's obviously something that this is something that's vital to our country's national security, and clearly any country could use this software to help them possibly prevent crimes and crimes against humanity. So obviously, the U.S. government, if there's any success on this, this is the last place the government's going to cut their budgets, no matter who's in control of the House or the Senate. And another one I want to highlight, they partnered with Hyundai Heavy Industries, which is Korea's leader in shipbuilding. This partnership is especially important because it's expanding its global reach, in particular to customers in the APAC region, Asia Pacific. So and also it helps prove that Palantir has got relevance in data-driven technologies. So as you can see, all three of these are very divergent, but very interesting contracts they have, and proves the width of the potential for this company. They're currently operating in over 50 different industries right now. So what I'm thinking is, when you look at the business mix of the company right now, they've got 42% from commercial and 58% from government. Years ago, that was much higher, and I think that's as that paradigm swings more towards commercial, and not that they're going to lose government contracts, but as they move towards that, that's a tailwind for the stock. And the thing, and a key metric about this company, which I mentioned earlier, but in terms of a surprise that you could see in this earnings call, or something that I'm looking for, is the customer growth. Because if you look at customer growth year over year, it's 80% year over year. And that's important because each customer, there's such a high amount of customization required for every customer. So the revenue growth can massively lag the customer growth. So what I mean is, like, it could take 12, 18 months once they acquire a customer to actually have revenue, because they have to build it for that customer. So those customers that they acquired last year may show no revenue. But once they start giving guidance on how long that takes to realize that revenue, you could see a big increase in revenue either this quarter or Q1 or Q2. Again, like I said, in the beginning of my presentation, I might be a little bit early on this, but I think that that's something that you need to look at going forward. And it's something that's a real tailwind to the stock. And like I said, like Ed said with his idea, this could be, 5 years from now, this could be 10 times of where the stock is. So, like I said, I'm cautious, but I think the stock could surprise higher. And if I'm right, even with a little bit of positive news, this company could retrace half of its loss of 2022 and go back to somewhere between 13.5 and $14. So in terms of structure, I restructured this trade recently. So what I did was now I'm long. I bought the February 8 strike calls for $1.70. February gets both this earnings call and the next one. And I sold against that the December 10 strike calls for 38 cents. I realized that I'm selling earnings on this earnings cycle, but I do this in a ratio, and I do think that what my plan to do is not only buy more, if the stock goes higher before February and below 10, maybe I'll sell an upside call against my February 8 strike call. So essentially, I'm hoping to have a call spread that costs me almost nothing net once I restructure the trade after December. So on a one-up basis, say you did this as a one-up basis, if the stock went back to 13.5, you spent $1.32 to make 418, which is a 3.2 to 1 risk reward. Stock goes to 14, you have over 3.5 to 1 risk reward. So again, and again, to me, I think there's a bit of a limited downside in being long that February call. Given that its earnings, they'll have a good amount of residual value and will keep its volatility inflated. So even if you wanted to unwind, if I was wrong, I think I could get out of this trade for a small loss if the stock completely shits the bed. But I do think this is a good structure that makes sense here, and a company that I believe in long term, even if it may take a while.
Great. That was fascinating to hear how much you're thinking ahead about what you might end up doing with the structure of that trade as you go forward. Really good insights for everyone watching. Gents, great to hear from both of you today. Really good ideas that you've gone through. I think one of the things that sticks out to me about this episode has been kind of the importance of having a really good, ready to go watch list, because you both talked about ideas that might not necessarily work straight away, and but are good for looking forward. So you need a good watch list to be able to draw ideas from in that sense. So yeah, I really enjoyed it. I'm sure all our viewers did. Thank you guys for coming on. Now, in terms of you guys, the viewers, there's just one webinar that I wanted to mention to you. It's on the 13th of November, and it's going to be hosted by Anton Creel and Benbow Green. The title is How to Make a Killing from a Bear Market Rally, and it's open to the public. So I'm really looking forward to that one. I hope to see as many of you guys there as possible. It promises to be an excellent one, and of course, really, really apt for the current environment as we try to keep all our webinars as. If you can't make it though, don't worry too much. There's lots of other educational content and offerings that we provide you guys with on our website, itpm.com, particularly courses, mentoring programs with guys like Ed and Raj here. Lots for you to take advantage of. So have a look at that in your own time if you can't make the webinar. But that is it for today. I hope you guys all enjoyed the episode, and catch us next time for another episode of What's on Your Mind.